Hi everyone, my name is Edwin Ho, and I'm the Client Advisor Lead at Endowus Hong Kong. We are Hong Kong's first fee-only digital wealth platform that takes no commissions from clients. Fixed income has been in vogue this year, but investors are now coming to terms with an uncertain interest rate path ahead. This comes as markets digest cooling inflation out of the US. So how should investors position themselves for the rest of the year to generate steady income through bonds? We are pleased to have from JP Morgan Asset Management, Jonathan Liang. He is the Asia ex-Japan Head of Investment Specialist within the Global Fixed Income, Currency, and Commodities Group. As a fixed income specialist, Jonathan is well placed to address the pressing concerns that investors may have about the trillion-dollar bond market. Thank you for your time, Jonathan. Let's kick off with this question. What are some key uncertainties over inflation that, if resolved, will help clarify the Fed's rate path in the second half of 2023?
Well, Edwin, there are a couple of factors that investors should keep in mind as it relates to inflation and its impact on monetary policy in America. The first is the level of inflation has actually come off quite a bit. Today's CPI in America is about half the level that it was in 2022. So the level itself is actually moving in the right direction. The issue is the speed with which inflation is moving down. And we feel that right now it is still not to the liking of the Fed, as in the Fed would like to see it go down even faster than it has so far. The other thing to keep in mind is the labor markets. The labor markets in America remains very strong. Average hourly earnings are still moving up at a pretty healthy pace, which is still putting upward pressure on inflation. So we think that a further deceleration in the labor markets will also be necessary. But as we continue to hike rates in July and maybe one more time in September, we think that is going to start to impact the real economy as well as the labor markets. So we think that by the end of the year, it'll be pretty clear that the Fed is likely done, and the markets will then start to price in future rate cuts even.
So given this current environment, what are some segments within the bond universe that you would recommend to investors?
Right now, as we look across the fixed income universe, the clear sector that we think is showing some value is actually agency mortgage-backed securities. Now, these securities are issued by U.S. housing agencies Fannie Mae and Freddie Mac, and they in turn are backed by the U.S. government. So these are AAA rated securities with no credit risk. And right now, their spreads are now trading at levels that we last saw during the global financial crisis. So these bonds are providing a nice combination of safety as well as a pretty nice yield pickup over US Treasuries. And we think that they also provide very healthy, high quality duration during a period where if the market starts to price in the Fed funds rate pause and then in future rate cuts, then these bonds we think stand to benefit.
If we may dive a little deeper into the specifics, how much duration risk should bond investors be taking on now?
Well, we think investors should take on some duration at this point in time, given that we are very near the end of the Fed fund rate hike cycle this time around. And every time when the Fed pauses, duration outperforms quite a bit. In fact, if you look at the last 6 rate hike cycles and then subsequent pause, every time when the Fed pauses in the subsequent 12 months, high quality duration has delivered double-digit type returns in the subsequent 12 months. Now, the issue though is that the yield curve in the US right now is inverted. And so right now you don't want to be too long duration because long end yields are lower than short end yields. So right now we think a combination of maybe having intermediate duration as well as having a yield curve steepen a trade on will likely benefit in the current part of the monetary policy cycle.
There also remains some debate on whether the high yield bond market is attractive today. What is JP Morgan's call on this particular segment, and how should investors position themselves if they are keen to take some exposure here?
This is a very nuanced question in that, so there's a couple of things that we need to keep in mind when it comes to high yield. On the one hand, fundamentals are actually pretty decent in US high yield right now. Leverage ratios on balance sheets have come off quite a bit. And right now, there isn't a lot of bonds maturing between now and the end of 2024. So while default rates may rise from here as we enter economic slowdown and even a recession, we think the default rate probably doesn't go up too much. So fundamentally, high yield is actually in a pretty decent shape. The issue, though, is that valuations right now is definitely not pricing in an economic slowdown or recession. And so from a valuation perspective, there are some risks. So if investors were to take some exposure in high yield, we would recommend that they stay high quality within the high yield market. So within high yield, that means in the BB credit quality space. And we also would favor the more economically less sensitive, more defensive sectors within high yields, such as telecom, utilities, etc. So a combination of high quality defensive exposure will likely be prudent at this part of the economic cycle. And then lastly, in order to further reduce risk, you can also use certain derivative instruments like CDX to actually reduce the overall beta of your high yield exposure. And we think that if that were to happen, if spreads were to widen from here, that CDX overlay will likely help to limit some of the volatility that you experience in this space.
Bond investors have different investment goals and needs, such as capital preservation. They are also working through different scenarios of expected rate changes. So how can investors better position their portfolio allocation amid these dynamic considerations?
Well, we think a couple of things. First of all, right now we think it is very important to take a dynamic and benchmark unaware approach to fixed income investing, because we are entering an inflection point in monetary policy cycle as well as the economic cycle. So you need to be very active and dynamic in the allocation of your portfolio during this inflection point. At this very moment, we would skew towards having high quality, intermediate duration, and try to hedge some of the beta within your high yield allocation and allocate to high quality sectors like agency MBS. But later on, that might change. We would currently advocate a yield curve steepener, but later on, if the yield curve were to uninvert, then we would need to change our position as well. So being very dynamic at this part of the monetary and economic cycle is going to be very important.
We are seeing continued strong interest in fixed deposits and money market funds among Asian investors. Are investors in Asia over-allocating to cash instruments as compared with the West? If so, is there a recommended allocation that investors should be mindful of so that their portfolio is optimized for their long-term retirement needs?
Well, a couple of observations I would make here is that when we look at our business globally this year, we see that flows in the US has been very, very strong into our fixed income platform. But in Asia, it's also positive, but not as strong as what we're seeing in the US this year. So it is true that your observation that maybe Western investors are more fully allocated to fixed income compared to Asian investors, which currently still favor fixed deposit, money market funds, etc. But while money market funds give you a pretty decent yield today, what they do not provide is potential capital appreciation. And in the last 6 rate hike cycles in America, every time the Fed pauses, high quality duration and fixed income has delivered double-digit type returns in the subsequent 12 months. So we think that having a higher allocation to fixed income than what Asian investors currently have is probably appropriate. But in the longer term, to properly plan for the retirement goals, proper diversification, balance between growth assets, safety assets, and high-yielding assets will be very important to achieve their long-term retirement goals.
Thank you again, Jonathan, for your time and sharing. To our viewers, we hope these insights will help your investment journey. Subscribe to follow Endowus on YouTube to stay updated on our video content. To find out more about what Endowus offers to investors, please contact us via the links in the description below. Thank you for joining us, and we'll see you again soon.